Okay, guys, let's look at the remaining questions in this section. So let's start with the first question. The price elasticity of demand for product at its current price level is inelastic. What will happen to total revenue and profit if the price of the product is reduced? Remember, when price is inelastic, which means people are not very sensitive to the change in price, or demand is inelastic, means the same thing. Then good thing would be to increase price, because if you increase price, demand is going to decrease, but not as much. Because of that increase in price, your overall revenue will increase and profit will increase as well. If you decrease price, the opposite of that will happen. And when price is elastic, then if you decrease price, even though there is decrease in your price, but because of that decrease in price, the units will increase and overall revenue and profit will be increased. So they said what will happen if the price is reduced. If price is reduced, both revenue and profit will reduce. Remember, they didn't say sales units. Whenever you decrease sales price, sales units is always going to increase, even if it is elastic or even if it is not elastic. But the thing is the revenue. So the revenue could increase more or less depending on when you decrease price, even though or when you increase price when it is inelastic, even though demand decreases, your all revenue will increase. So they're not talking about units, they're talking about revenue. So revenue will fall, profit will fall as well. Which of the above statements are true? The following statements have been made about price elasticity of demand. When sales demand is inelastic, a company can increase profit by raising the selling price of its product. I just explained, when it is inelastic, the good strategy is to increase selling price. And then price elasticity of demand is measured as the amount of change in the sales price measured as a percentage of current price divided by the change in quantity demanded measured as a percentage of current sales volume. The first statement is true, the second one wrong, because it is actually the other way. It is the percentage change in demand divided by the percentage change in price. Okay, next. So yeah, here only first one is correct. Match the products to the order of priority in which the company should make them in-house rather than purchase them externally. A company makes and sells 4 products. Direct labor hours are scarce resource, but company is able to subcontract production of any products to external suppliers. The following information is relevant. We have the sales price, variable cost, cost of external supplier, and direct labor hour per unit. Remember, we have make or buy decision in 2 situations. One is make or buy decision with limiting factor. One is make or buy decision without limiting factor. In make or buy decision with limiting factor, some products have to be outsourced even though if supplier is charging higher. But in make or buy decision without limiting factor, we only outsource products if they are cheaper externally. So they said here, direct labor is scarce resource. It means it is a situation where we have limiting factor. So the priority should be given to the product. The buying priority and making priority are opposite of each other. So the product that you give priority, the first priority of making, last it will be priority of buying. So always focus on the word which priority they're asking. So they're asking match the products according to the priority in which the company should make them in-house rather than purchase them. So which one should be made first and second and third? Okay. So what we will do is look at, remember, sales price is not relevant. We can sell it at the price that we want. It doesn't have anything to do with the cost of the supplier. So when we look at product W, it is $1 expensive from supplier. If we look at product X, it is $2.1 expensive. Y is $2 expensive, and the other one is $1 expensive. Remember, if this was make or buy decision without limiting factor, none of these products would have been bought, because all of them are expensive externally. But because this is make or buy decision with limiting factor, we have to look at the extra cost, not per unit but per limiting factor. So here it costs $1 expensive and it takes 0.10 hours, so it becomes 0.10 per hour. The other one costs 0.21 divided by 0.30, it becomes 0.7 per hour. And this one is dividing by 0.25 is 8, and the other one 1 divided by 0.20. So whichever are less expensive per hour, that would be bought as a first priority. Like here, it costs $1 expensive. See, the way it works is conceptually, it costs $1 expensive externally, but it takes only 0.10 hours of the time. So if we look at it as overall, it is 10. So looking at the time that if we are spending on it, and if we make it ourselves, it would be as if it costs $10 expensive outside. So the cheaper it is outside, the higher it will be in priority. So in buying priority, if I'm making, this one would be bought first, this one would be bought second, this one would be bought third, and then this one would be bought fourth. This is the buying priority. So making priority is opposite of buying priority. So this one would be made first because it is cheaper inside, and then the second one would become third, and the third one would become second, and then the first one would become fourth. So priority of making or buying are different. So because they said in priority of making, then the first would be product W, second would be product Y, third would be product X, fourth would be product Z. Okay, which method of pricing is most easily applied when two or more markets for the product or service can be kept entirely separate from each other? Remember, we studied in pricing chapter, this is called price discrimination, charging different prices either according to market or time or any other factors. So price discrimination. What method of uncertainty or risk analysis is also called what-if analysis? Decision tree, sensitivity analysis, simulation model, stress testing. Sensitivity analysis is also called what-if analysis. The reason is because we are assuming if there is a certain percentage change in a variable, what will happen. For example, material cost. We could say if material cost changes by 10%, what will happen? That percentage is actually the sensitivity. It is also called what-if analysis. It doesn't actually happen, but we say, what if it changes? Okay, what is the value to the company of obtaining the perfect market research information, ignoring the cost of obtaining information? A company wishes to go ahead with one of the three mutually exclusive projects, but the profit or cut from each product will depend on the strength of the sales demand as follows. We have project 1, project 2, 3, and probability of demand. Okay, so remember to value perfect information, to find the value of perfect information, we use expected value. First, we look at the projects without perfect information, and we look at the project whichever is higher, and then we see if we get information what will be the highest we can earn. So without perfect information, if we look at our current projects, the first project 70,000 0.10, 10,000 at 0.40, and minus 7,000 at 0.50. So what I'm doing is finding expected value. 70,000 at 10%, 10,000 at 40%, and minus 7,000 at 50%. So expected value is 7,500. The second project, 25,000 multiplied by 0.10, 12,000 multiplied by 0.40, and 5,000 multiplied by 0.50. It's 9,800. 50,000 multiplied by 0.10, 20,000 multiplied by 0.40. Probabilities are same. Minus 6,000 multiplied by 0.50. So if we wanted to select project without perfect information, we would have selected project 3 because it gives us the highest return. Now if we can get perfect information, if we know the demand is going to be strong, then we would choose project A that would give us the highest return. If we know that demand is going to be moderate, we will select project 3, which would give us highest return. And if we know that demand is going to be weak, we are going to select project 2, which will give us the highest return. And when we find average of this, it becomes 17,500. 17,500 minus 10,000 that we could already earn. So 7,500 is excess, and this is the value of perfect information. What it simply means that we should be willing to pay up to maximum of 7,500. It doesn't mean we should pay 7,500. This is the maximum limit. Okay, next. So the answer here is D. A company must decide whether to agree to the customer's request for the work and to set a price. What would be the relevant cost of material M for this job? A special job for a customer will require 8 tons of material M. And the company no longer uses this material regularly. Not regularly used, purchase price is not relevant. It holds 3 tons. Remember, we hold 3 tons, but we require 8 tons. These originally cost 44 per ton. Not relevant because we are not regularly using it. If you don't understand this, go back to the decision-making chapter where I explain relevant costing, relevant cost of material. Then you will understand. And could be resold for to a supplier for 35. We bought it for 44. We have 3 tons. We can sell it to supplier for 35 if we want. So this could be a relevant cost. Alternatively, the material could be used to complete another job instead of using other materials that would cost 126 to purchase. So what we could do is use this material instead of selling it to supplier. We could use it instead of something else, and it would save us $126. If we look at 35 multiplied by 3, it will save us $105. But when we look at 126, 126 is a better use. So 44 would not be relevant, even though we paid for it 132, but because we are not regularly using it, that is not relevant, and the current purchase price is also not relevant. Even if we regularly use it, the original purchase price is not relevant. The new purchase price, if available, is relevant. So we are not regularly using, so we would look at another alternative, highest use. It is simply opportunity cost. The current market price of the material M is 50 per ton. is not relevant because we don't regularly use it. So for 3 units that we already have, the price would be 126 because this is the highest benefit we can get, and the remaining 5 we have to purchase at current price, which is 50. When we add both of them together, it becomes 376. So 376 is the relevant cost. Okay, what is the break-even point in sales revenue per month? A company makes and sells a single product when sales per month are 6.8 million, total costs are 6.56 million. When sales per month are 5.2 million, total costs are 5.44 million. There is a step cost increase of 40,000 in fixed costs when sales are 6 million. But the variable unit costs are constant at all level of output and sales. Okay, they haven't given us variable cost, but they have given us the sales and the cost at 2 levels. So what we can do is use high-low method technique that you guys studied in F2, and we will find fixed and variable cost. But remember, for a high-low method to work, there needs to be variable and fixed cost. When we have a step cost like here, that step cost has to be removed. So sales are 6.8 million. So we will take this as units, 6.8 million, and 5.2 million. We will take that as another unit. And we are going to take the cost and divide it by this. So 6.8 million, remember, is higher than 6 million. When sales becomes 6 million, there is a step cost of 400, which means that this 6.56 million total cost here would include that step cost. That step cost has to be removed. Otherwise, high-low method will not work. So now I will take that high cost minus low cost of 5.44 million. So take the cost difference divided by unit difference. It will give you difference per unit, or this is variable. Now this is not variable cost per unit, it is variable cost per dollar of sales. So every $1 sales incurs 45 variable cost. Or you could say 55% is contribution to sales ratio. Okay, now we have to find fixed cost. Take any activity, take total cost minus variable cost from that activity, it will give you fixed cost. So I have taken the higher activity, or if you take lower activity, it should give you the same result. So if I take 5.44 minus the variable cost, multiply by the sales, it should give me same fixed cost. So fixed cost is 3.1 million. 3.1 million divided by that CS ratio of 0.55 will give us 5.63 million break-even point. But remember, when sales become 6 million, there is an increase of 400,000 fixed cost. So we have to double check to see whether there will be another break-even point. 3.5 million divided by 0.55 becomes 6.36. So what happens is, if our sales increases to 6 million, if our sales are lower than 6 million, then our break-even point is 5.6. But if they increase, then we have to make further 0.36 million sales to have break-even point. Remember, in pricing chapter, there was a topic about decision to increase capacity. Sometimes you can increase capacity, but because of that increased capacity, there could be fixed costs that you incur, which could ultimately mean that you make loss actually. So we have two optimal points here. So if our sales are limited up to 6 million, we have 5.6 million break-even point, but if they exceed, our break-even point would be 6.36 million. Okay, next. If the choice of selling price is based on max-min decision rule, which price would be selected? A company wishes to decide on the selling price for new product. Weekly sales of each product will depend on the price charged and also on customers' response to the new product. The following payoff table has been prepared. We have price, unit contribution, weekly demand, best possible outcome, most likely outcome, and worst possible outcome. So what they have done is they have prepared this payoff table, but the thing is they have only included fixed cost units in it. So we have to convert these to contribution. So if contribution was given, this would have been very easy. If I was deciding maximum decision rule, which is maximum of the minimum, here the minimum is 6, here the minimum is 5, here the minimum is 4, here the minimum is 6. So maximum of the minimum would have been 6,000 and decision would be P1. But to be accurate, we need to convert it to contribution. So we have 10,000 multiplied by unit contribution 3, 8,000 multiplied by 3, 6,000 multiplied by 3. Sorry, this is 80,000. The next one is 9,000 multiplied by 3.5. Remember, contribution is different for each price. The higher the price, the more the contribution. And 5,000. Next, 8,000 multiplied by 4, 7,000 multiplied by 4, 4,000 multiplied by 4, and then 7,000 multiplied by 4.5, 6,000 multiplied by 4.5, and 3,000 multiplied by 4.5. So maximum means maximum of the minimum. So here the minimum is 18,000, here minimum is 17,000, here minimum is 16,000, here minimum is 13,000. So maximum of all these minimums is 18,000. So according to maximum decision rule, P1, because this relates to P1, P1 would have been selected. If they asked maximax, then maximum of the maximum, here the maximum is 30,000, here the maximum is 31,000, here maximum is 32,000, here maximum is 31,500. So maximum of maximum would have been 32,000. So price 3 would have been selected. So here the answer is P1. Okay, continuing. A company produces and sells a single product. Budgeted sales are 2.5 million, budgeted fixed costs are 360, and margin of safety is 400. What are budgeted variable costs? Okay, so if our budgeted sales is 2.4 million and we have a fixed cost of 360 and margin of safety is 400, which means that margin of safety is 400. What it simply means is budgeted sales is 400,000 more than break-even sales. So if we minus that from budgeted sales, it will give us break-even sales. So at 2 million sales, we cover our fixed costs. If at 2 million we cover our fixed costs, then that means contribution would be 1.64. So if 1.64 is contribution, if I divide that by 2 million, it gives me 0.82%. So 0.82% would be 0.82% would be the variable cost. So this is not the contribution, this is variable cost. Contribution is the 360,000 that is earned, which is covered. So 64 is variable cost, dividing by 2 would give us 0.82% variable cost. So if at 2 million it is 1.64, at 2.4 million multiplying by 0.82, it will be 1.968 thousand, which means C would be correct. Next, if a decision is made solely on the basis of short-term cost consideration, what material should company purchase externally? A company wants to decide whether to make its material in-house or to subcontract production to external suppliers. So from the first sentence, you see that it seems it is like make or buy decision without limiting factor. In the past, it has made 4 materials in-house, but demand in the next year will exceed in-house production capacity of 8,000 units. Okay, so up to currently, we were making all of them inside, but now there's a limit that will be exceeded, which means up to 8,000 maximum we can make. So now it is make or buy decision with limiting factor. So from the first sentence, it seemed like it is make or buy decision without limiting factor. But there are many tricks in the question, so always be focused. All 4 materials are made on the same machines and require same machine time per unit. Machine time is the limiting factor, limiting production factor. Okay. We have units, the in-house cost of making, directly attributable fixed costs, and cost per unit. Remember, when we have make or buy decision, we usually look at the variable cost, but when there are fixed costs and they are directly attributable, then those costs will be looked at as well. And we usually look at cost per unit, but when fixed cost is there, we have to look at total cost, because fixed costs are not per unit. If you are producing a unit, for example, if I'm producing W, then this 5,000 cost will be incurred whole, even if I make 1 unit. So obviously it will not be a good decision to make half of these units. For example, if I make 2,000 units, if I make 1,000 units, then these costs will be incurred. So we will look at the cost not per unit, we will look at the overall cost. So the overall cost, if we make in-house, is 8 multiplied by 4,000 units plus the fixed cost is 37,000. 12 multiplied by 2,000 plus 8,000 becomes 32,000. 9 multiplied by 3,000 plus the fixed cost of 6,000 becomes 33,000, and 10 multiplied by 4,000 plus fixed cost 7,000 is 47,000. So the external supplier has offered to at 9. So same units, we don't have fixed cost, only the variable cost when we buy from supplier. I think it's easier to just type it. Okay, we have 18 multiplied by 2,000, 12 multiplied by 9,000, 3,000, and 12 multiplied by 4,000. So if we look at the costs, which are expensive, this one is expensive, this one is expensive as well, this one is expensive as well, this one is actually cheaper. So we have limiting factor decision as well, but still supplier is charging cheaper. Obviously, first, which is product W, would be outsourced. Even if we outsourced product W, remember we have 2, 3, 4, which is 9,000, and our capacity would be 8,000 units. So what we will do is whichever is sold cheaper, less expensive outside. That would be the next thing we outsource. If we look at this 48,000, it is only 1,000 expensive. So we will buy the whole 4,000. Why the whole 4,000? Because there is this fixed cost involved. If fixed cost was not involved, I would have only bought up to 1,000 outside, but because there is fixed cost involved now, I will buy the whole 4,000. So 4,000 of Z and 4,000 of W would be involved. So remember, when there is fixed cost involved, the way you answer it is a little bit different than when there is no fixed cost involved. Okay. A company makes two products with the following characteristics: contribution to sales ratio, selling price per unit, maximum demand 8,000, 3,000, fixed costs are 9,000. What is the minimum revenue required for the production to break even? Remember, whenever there is a multiple products question, break-even point, we need a sales mix. They should tell us the mix in which sales are sold. So I would assume here that the mix is 8,000 and 3,000. But there is a difference in requirement as well. They said here, what is the minimum revenue required for production to break even? They didn't say what is the break-even point. They said what is the minimum sales. So if there were two products that I was selling and they were not sold in a mix, which they didn't say here, then I would first sell the one that gives highest profit. Or if I want to, if I wanted to earn contribution, first units that I would like to sell would be the ones that give us the highest contribution. And then after that, any other units. So theoretically it works. Obviously, practically, demand per week or per month could be different. So if we look at the situation here, if we look at product X, its sales price is 3 and it has a contribution to sales margin of 0.90. If we look at product Y, contribution to sales margin is 50%, which means 2.4. So this gives us the highest profit. So that means all units of these will be sold first. And there is a maximum limit, so we can only sell up to 3,000. Otherwise, if there was no limit, the only product that we would sell would be Y. But because there is limit, we cannot sell whole Y units. So if we sell 3,000 units of Y, how much contribution it will give us? 3,000 multiplied by 4.80 multiplied by, or I can directly multiply by that 2.40. It will give us 7,200 contribution. If our fixed cost is 9,000 and we have 7,200 contribution already earned from product Y, remaining is 1,800 contribution. So that 1,800 contribution would be made by how much sales revenue dividing by the CS ratio, contribution to sales ratio, is 6,000 sales revenue. So 3,000 units, they ask in revenue, so multiple 4.8 would give us 14,400 sales plus 6,000 would give us 20,400 sales. So the minimum sales that we need to do to achieve the break-even point would be 20,400. So remember, always focus on requirements. Okay, the demand for a product at its current price has a price elasticity greater than 1, ignoring the minus sign. So price elasticity of greater than 1 means it is elastic. Which of the following statements must be correct? A reduction in sales price will increase total revenue. A reduction in sales price by X percentage will result in increase in sales demand, which is greater than X percentage. An increase in the selling price will increase total profit. So price, let's start from the third one, which is the simplest. If we increase selling price, I already explained this, that's why I wanted to focus on this one first. Remember, I already explained when we increase price, when it is elastic, even though there will be increase in selling price, but because of that there will be decrease in demand, and that decrease will be huge, and because of which profit will decrease. So third one would be wrong. So if third one is wrong, so what is left is 1 and 2. Remember, this is elimination method. Sometimes even if you don't know the whole options, you could answer a question. But let's look at the second. A reduction in sales price by X percentage will result in a percentage increase in sales demand, which is greater than X percentage. Yes, remember, the percentage change in sales will be more than the percentage change in price. A reduction in sales price will increase total revenue. Yes, if we decrease sales price, our price per unit will decrease, but because there will be increase in demand, because of which our overall revenue will increase. Okay, what is the value to the company for obtaining this perfect information? I believe this is similar questions, you could do it. What is the budgeted cost? What sales will be needed to achieve a target profit of 40,000? So this is multiple product break-even point. Not difficult, but still let's look at it. A company budgets to sell its 3 products A, B, and C in the ratio 2:3:5 respectively. Remember, when we have multiple products, usually there is sales mix given. Okay, so sales price is 20, 18, and 24. Variable cost is 11, 12, and 18. Budgeted fixed costs are 1.2 million. What sales will be needed to achieve a target profit of 400? So we are not just covering the fixed costs, we also want to earn profit. So what should be the sales revenue? Okay, so let's first look at contribution of all of these products. Now let's multiply them by units. Remember, there is 3 units, so 2 units and 3 units and 5 units. So what I've done is multiplied by this proportion. So it will give me total sales in a mix. What I will do is put this in bracket, divided by total units in a mix, which is 5 and 5, 10. This is average contribution per unit per mix. So next, what we will do is find CS sales, which is 20. So remember, when you are doing multiple product break-even point, you always find average per unit per mix. That is the key thing. So this becomes average sales per unit per mix. So if I take 6.66 divided by 6.6 divided by 43.20, it gives me 0.15%. Let's double check to see my calculation is right. 20, 18, 24. Remember, when you have blank questions, always double check your answer. If they are multiple choice question, I would not worry about it as much, because there wouldn't be enough. If my answer matches, I would be happy about it. I would not double check it. But if it is blank question, I would always double check. Okay, yeah, I've done something wrong here. I multiplied by the contribution. Let me copy this again. Multiply by 20, multiply by 18, multiply by 24. This becomes sales per unit per mix. Now taking contribution per unit per mix divided by sales per unit per mix will give me CS ratio. Now taking that, taking our fixed cost, which is 1.2 million, plus the target profit that we want to earn, 0.4 million, dividing by this will give us 5.1 million sales. Up to 3 decimal points they said, so it would be 5.11. If I wanted to put it there, it would be 5.188.